I'd like to start with the buyer's dilemma. And this is really, something that a lot of you hopefully can relate to. So the buyer's dilemma um, speaks to Mike. So Mike might claim his business makes a profit of $900,000. You, as the potential buyer, needs to carefully distinguish between the owner's personal spending and the actual cost required to run the business. Um, this is where Addbacks become crucial because they provide a clear and accurate view of the business's true financial performance. So let's take a step back and break this down. So if you flip open a sim and you see that the business makes 900K of profit, you'll see things like revenues. You may see expenses on the income statement. There may be descriptions like salaries and wages. Cost of goods, cost of sales, a rent line item as an expense, um, things like officer compensation, which sometimes is also referred to as owner compensation, a line item. The question is, what is the true value of the business? So if we isolate what are the true business revenues, what do those look like? And then more importantly, what are the actual expenses to run this business? So things like, the payroll of the employees who work for the company, um, the cost of goods sold. So if you have to buy raw materials, and other items in order to generate those revenues, uh, what do those costs look like? What is challenging in the small business acquisition world is a lot of these small businesses, especially legacy, which have been around for dozens of years, the owners taking advantage of um, tax tactics in order to lessen the taxable income on the business. So you may see things like personal expenses, et cetera, that may or may not be required to run the business. So this is really where the inflection point of the Addback analysis comes into question, because your only objective is to understand, in a timely fashion, like what does this business actually spit off cash wise, um, and strip out a lot of the noise around, these business or these personal expenses that might be on the P&L and lowering this net income. So what is this buyer's dilemma? How do you find the true value? So you start out with assessing the core value. And if we want to go to the next slide, from there, you want to adjust the profit for some of these add backs. You want to look at things like owner expenses, identify the personal costs in the books, and then from there, you want to validate the add backs. So you want to understand, what's non-recurring, what are some of the necessary items of the business, and then from there, it should show you what is the true cash flow for valuation. So what are some add backs? Add backs look like things like irregular expenses. Um, if you want to flip to the next slide, costs that don't follow a consistent pattern and vary significantly over time. What are other add backs? Think things like non-recurring expenses. Non-recurring expenses could be, one-time expenses that won't appear in future financial statements. Larger non-recurring costs could be, you know, lawsuit related. So if the business had significant legal fees or transaction fees that it incurred on the financial statements, it's very likely these things won't occur again. So those are things you may see as add backs as well. And then things that look like discretionary spending. So these are personal expenses. So think, if you see a vacation, a car lease that looks like it's non-operating in nature, those expenses are very likely the discretionary owner costs that a broker or the seller may try to make the case of this is not business related. Uh, so the question really is, once you've identified like what are the add backs, why does this matter? Like, what's the point? So I think it's important to understand like why these add backs matter. So uh, for buyers, it paints a clear picture. So let's think back again. If you are actively searching for a business and you see these ad backs in the SIM and marketing materials, um, these ad backs are important to verify because you want to first make sure that, okay, are these expenses operational or are they really personal in nature? Um, in my opinion, the legitimacy of ad backs should represent non-operational costs only. So if you are confident and the ownership group, the burden and the obligation is on the sellers and management team, they need to prove out through quantitative and qualitative factors why these items should be add backs and why they are really not expected um, to be incurred by the business going forward, whether it be personal in nature, are they really one time? Um, or are they discretionary owner expenses not critical to the ongoing revenue sustainabilities and profit sustainabilities of the business? That's really the question. Um, that is the question that they must answer through the support they provide. Um, when you do go under contract in LOI, uh, the shift occurs where the ad backs presented in the SIM now need to be substantiated through supporting documentation. Jumping to the end of this story, so the end goal of this is if the sellers and management team cannot reasonably support the ad backs through general ledger support, tying it back to where it appears in the income statement, and by providing qualitative and quantitative detail, those add backs should not be included in the valuation. What that means in deal making terms is it's very likely the purchase price will be lowered. And this is sort of like an inflection point of a lot of deals. Um, so what the add backs do is hypothetically, if the owner is adding back $100,000 of expenses, it is effectively increasing the profitability of the company they're trying to sell. If the company they're trying to sell for 3 times earnings, every dollar they're looking to add back is multiplied by 3. You have to pay them $3 more for each add back that is validated. Um, that is using the simple principle of a fair market multiple, which could be 3, 4, 5 times, um, multiplied by the adjusted earnings of the company. So that's really how we, tie a knot into why these add backs matter, whether they are validated or invalidated. Um, it's really a profit. And when I say profit, I mean it is the enterprise value that you're going to pay for the business. So this is a dollar for dollar analysis, and very much it's a 3-to-1 or 4-to-1 based on the market multiple. So you need to validate or invalidate each add back that is provided. So if we want to skip down to two, so what are commonly accepted add backs? So these are the types of add backs. Again, you have non-operating, discretionary, and non-recurring. So when you're reviewing the add backs proposed in the SIM or whatever document you receive, be on the lookout for these 3 categories. Non-operating expenses, these are going to be things that are not required for the operations of the business. So you'll see here the two examples listed here. Um, Real estate holdings, not so much in small businesses. Vehicle expenses, you'll see that a lot in small business deal making. Um, if it's the owner vehicle or the owner's wife's vehicle, um, these aren't going to be work vehicles. If that's the type of business you're looking to purchase, discretionary are going to be owner discretionary examples. Those are very straightforward. Uh, Non-recurring items is where we start to enter the gray area. So you need to be on the lookout for things that might fall in this bucket. So non-recurring expenses could be, examples like technology upgrades, uh, donations, relocation expenses. These are just some of the examples. Equipment purchases. Um, Items that fall in the non-recurring bucket, a lot of times when I look at Addback, when I'm conducting the Addback analysis, those items are invalidated because in reality, those are actual business expenses that if you were the owner of the company, you would have incurred. Just because they elected to do a technology upgrade, you could make the case that the technology was, needed to be upgraded and you should not be giving them credit and effectively paying them a higher purchase price because they made necessary upgrades to sustain the business operations. Another example might be equipment purchases. So if it's a heavy equipment business and they made a one-time, a larger purchase because the equipment was very old, that's another example where if the company was not being sold, they would have had to make this purchase. So it's not an appropriate add back, in my opinion. Uh, I'll say with a caveat, there are certainly a set of circumstances where you can make a case one way or another, but this non-recurring bucket is what I like to call the gray area of this add back analysis. Discretionary and you know very much personal or owner expenses are very easy to identify, especially for those folks who may not be as familiar with this analysis. When you start to enter the non-recurring bucket, that is when you should be pushing back and questioning, is this really a valid add back, or are they trying to get more credit for things that are actually business related? So, what are some types of that? What are some exact tangible add backs you can be on the look for? So, what are some commonly accepted add backs? So, commonly accepted add backs include things like excess owner compensation and personal benefits, um, family payroll, one-time expenses, and then again, we talked about non-recurring items. So these are some commonly accepted add backs. So these are legitimate add backs, which you can give the owner credit for, and therefore increase the earnings uh, of the company. Therefore, give them credit for a higher purchase price. Now we touched upon non-recurring items. Again, that's a gray area where you could make a case one way or another. I would dig into the details and really ask yourself, was this a necessary business expense because the equipment was old? Or did they purchase equipment when they didn't really need to? More often than not, they purchased the equipment because the business needed it to continue operations. So I would actually push back on that last one. I don't always accept that add back. Add backs I typically will approve as reasonable is excess owner compensation, family payroll, um, and then one-time expenses. So if the owner is paying himself a salary of $500,000 and he is recording that payroll expense on the books. It's very likely going to be included in officer compensation. You could make a case for adding back a portion of that salary. So let's say hypothetically, the 500,000 you can trace back to the expense line item on the income statement. Um, the add back that I would accept would be the difference between the full amount of the owner compensation recorded on the P&L, which is 500,000, less whatever your go forward salary is. So you could use a benchmark of 100,000, 200, etc. And the difference between those two numbers is what ultimately should be the net impact of the add back. So that's one small example of the actual way you can conduct this analysis. As I'm going through this, if it gets a little too heavy, feel free to put that in the chat, a question, or in the Q&A, and I'll try to get to as many as I can. This is definitely very a fluid conversation, so if you have questions around it, I find explaining this in a live setting can be very beneficial. So family payroll. So if you have things like the wife, if there's an owner and a family of four is being recorded on the payroll, if you conduct an analysis and it looks like the owner's son and daughter on the payroll, but they are not involved in the business, I would encourage you to have a meaningful conversation with the owner about their roles and duties. If they really don't do a single thing for the business, you can make a case of adding back their entire salary. If you uncover that they have some part-time work, the son and daughter are running some administrative items for the company on a part-time basis, I would not add back the full amount that they're paying them, because very likely you would have to hire out someone else in order to do some of those duties. So this is an example, family payroll, where management and the sellers may try to get full credit for the amounts paid, when in reality, you can make a case that 60% should be included, which turns into real dollars. So if family payroll was $50,000 total, you could make a case that, let's say, half was an accepted add back. If you remove $25,000 from the add back at a 4 times valuation, you're lowering the earnings potential of the company and the purchase price by $100,000. So again, the dollar for dollar impact is multiplied based on this market multiple. Call it 3, 4, or 5 times. So the golden rule is if the business needs it to operate successfully under new ownership, it is not an add back. I'll say that again. So in add back analysis, if this business expense is needed to operate and continue successful business operations going forward, you should not be accepting this as an add back, because you will need to incur those costs going forward. When in doubt, be conservative. Do not let the sellers and brokers include all of these add backs, which you may need to actually expense as the new business owner. Legitimizing add backs is the whole crux of this analysis. When in doubt, be conservative. If you have a feeling that these expenses are actual business costs, push back to the ownership group and have a meaningful conversation. Explain what these add backs should look like in your opinion, and then have a meaningful dialogue about it. Very often, this is a gray area and a conversation. The end goal is to show what the business potential, the business earnings potential is going forward. It's not to prop up the business to look more profitable than it actually is. So what are some other best practices for, this ad back success? So I talked about documentation, but when you receive a list of ad backs, you want to ensure that every ad back must have detailed financial support and clear rationale. So buyers are going to scrutinize as buyers, you should scrutinize these adjustments and ensure that they're maintaining records, invoices, in order to validate these ad backs. If the ad backs cannot be validated by the management and sellers, they should not be included and you should not give them credit. Um, so this is an interesting topic which comes up often where sellers may try to explain away why ad backs, they can't dig up all the support, why it doesn't tie out to the ad backs shown in the sim. And it's a challenging place to be. And it's an uncomfortable position as you, the prospective buyer, which I understand. So I'd give you two pieces of advice. One, leveraging a third party to be the bad guy is critical. If you hire anyone to do financial diligence, ad back analysis, and this dialogue is something we do all the time. Um, if you want to maintain rapport, which is very important, um, using a third party to be the bad guy is a very good tactic a lot of sellers will use. Um, when sellers cannot provide detailed support back to the ad backs, those ad backs are now invalidated. So I'll give you an example. If they want to add back $50,000 of um, personal expenses, if they cannot provide general ledger support for $50,000 as well as a few invoices, um, those amounts that are not validated cannot be included. And it's a very simple dialogue. It is, I'd be happy to give you credit, and you can use this when you're talking to them. You could say something like, um, I, I understand you proposed some ad backs. I would be happy to give you credit for those ad backs, but I need a few things in return. You need to provide general ledger support so I can clearly see how you came up with those ad backs. Um, the support needs to include some descriptors around what the items are. And if you're able to provide those and it's reasonable, I would love to give you credit for it. If you can't provide those for whatever reasons, I may not be able to give you credit for those ad backs because I cannot prove out those are not legitimate business expenses. That simple dialogue is a very easy way to just, take out the emotional elements around ad backs and explain that this is just a fact-finding mission. So, remember, ad backs should reveal the true earnings potential of the business. It should not inflate it. Credible adjustments build trust. Aggressive ad backs, which are invalidated or cannot be supported, often can destroy deals. So if you're a seller, and I tell this to all my sellers, if you are a seller looking to have ad backs, be conservative and do not be overly aggressive on ad backs. It is not a good reflection of you, the business owner. It looks like you're trying to pull one over on the buyers. And quite frankly, it's going to be discovered. In due diligence, your books are going to be analyzed, very detailed, because there are millions of dollars on the line, and any good buyer should be doing this analysis, um, line by line. And they should not stop until they have full comfort around all the ad backs because they are paying multiple dollars for each dollar you're looking to add back. So just keep that in mind as we go forward. Um, Couple questions came in, so I'm gonna address those, and then we'll keep it moving. So the first one came in. It says, since purchase price tends to be set on the most recent normalized EBITDA, what should you do with add backs that are historic, 1 to 2 years ago, or future dated, normalized management salaries, etc.? Thank you. So uh, I really appreciate the question, and I'll try to break it down. So, what should you do with add backs that are historical nature, 1 to 2 years ago, or future dated? So the purchase price, I'll push back and say the purchase price not always is set on the most recent normalized EBITDA. I assume you mean maybe the last 12 months. Typically, the purchase price should be a combination of the average over the last 3 years, or 2 years. So if they're trying to set a purchase price for a business that's been in existence for 20 years and they're only going to use the last 12 months, that's your first problem with the valuation. I won't get into whether a business is valued above market or below market, but that's something to look out for. When you're focusing on add backs, I would focus on ones that are in, the most recent period. So add backs that are being included in each period. So if it's 25, 2024, and 23, I would begin to focus on those because those reflect each period. If there's an add back in 2022 alone, that is a less risky add back because it doesn't impact the valuation as much. There are a different set of circumstances for each deal, but that's how I think you should be prioritizing this add back analysis. Um, do the add backs, another person asked, do the add backs reflect the purchase price? Absolutely. So what we kind of just talked through is validating these add backs directly impacts purchase price because whether or not they're included, if you invalidate some of these add backs, likely your incomes, your adjusted incomes are going to decline. So if we go back to the $1 million example, if you are trying to add back $100,000 of add backs, if some of those are invalidated, your earnings, which you showed as 1.1 million, may be 1.5 million or 1.05 million. So right then and there, your earnings, which you're showing of the company, has declined. I'll get to a few more questions a little bit later on, but we're going to keep it moving. So again, we talked about some of these best practices. So I don't think we need to overemphasize this, but properly documenting these add backs create win-win outcomes. So sellers need to properly document and show support for these add backs. So that's the key here as buyers. Most of the crowd is typically buyers who's on this webinar today. You need to ask for proper documentation and you need to tie back the dollar amounts from the support back to the add backs. If they do not tie back, you need to if they do not tie back, you need to have a conversation around what is the challenges of why the support is not tying back. Aggressive add backs hurt credibility, so be on the lookout for that. Owners should be taking a conservative approach when it comes to add backs, because by overstating earnings, you are setting yourself up for a deal that cannot pencil with the SBA and overstating the earnings potential of the company. So we're going to switch into an example of a recent deal, and I'm going to walk through some of those add backs. So here's an example. I'm going to share my screen. If you can't see it, let me know in the chat and I will zoom in. So here we go. This is a modified screenshot of a SIM I just looked at. So picture this. This is a screenshot of a SIM. Picture 25, 24, 2023, and so on and so forth. So in this example, here are your owner adjustments. So the business on a reported basis is showing incomes of 800,000 before taxes. With these adjustments, these are the owner add backs you'll likely see. So what are they trying to add back? They want to add back the owner compensation. In this case, it's called officer compensation. So this very likely represents the owner salary that the owner is paying himself on an annual basis. In this case, it looks like it's about $178,000. I'd make the case that if you are buying this business, and again, this is when it goes into the SDE versus EBITDA conversation, seller's discretionary earnings are the earnings excluding the owner compensation. If you are buying this business, you very likely are also going to be paying yourself a salary because you're trying to replace your income. I would make a case that the officer compensation here should be adjusted because you should not be expected to not take a salary going forward. So this 178,000 should be offset by, let's say, $150,000 going forward. What's next? They're trying to add back things like interest, depreciation, valid add backs, in my opinion. We go down to things like officer auto expenses. This is very likely a vehicle expense. A vehicle expense. You can make a case that this is valid if they aren't driving to on-site visits, etc. Again, you as the owner likely is going to take advantage of these expenses and benefits. So you can make a case that if the owner is using this for business purposes, it should not be added back. If this auto expense includes leases for other family members not involved in the business, then you can make a case, the business is not going to be paying for that going forward. What else do we have here? We have things like donations. So donations are a tricky one because when you have questions around this, it depends on the dollar amount. So right now, the donations add back is $5,000. $5,000 in the grand scheme of things is an immaterial add back. Again, it's still dollars, so you can have a question around it. But be on the lookout for donations which in reality are not truly discretionary. I'll give you a few examples of what I see in practice. So on a few recent deals, there were expenses recorded under this donations category, which were actually paid to customers of the business. So the customer, a large customer had a charity or donation they ran in conjunction with the company. Maybe the owner of the customer the business was doing some work for also led a charity donation, whatever. It was expected that given the relationship of the company, they would be donating to them, every year. In this case, that amount paid, which is being recorded as a donation, needs to continue going forward. This is an example I see from time to time where the sellers and brokers, they're trying to get full credit, saying that the donations, they don't need to occur going forward. I would make the case if I was the customer, regardless of who's in charge, if this donation stops coming in, I may think about looking elsewhere and not doing business with this company anymore. So while it's technically, discretionary, you can make a case that depending on who the parties involved are, these donations are actually just business expenses that need to be paid going forward. Believe it or not, sometimes this donation amount can be $50,000. I've even seen some at $100,000 because again, these are more often the cost of doing business and maintaining relationships with large customers. And they're not so much as church donations or charity. So be on the lookout for charity versus donations for business. Officer benefits is another one that comes up. Typically, this number could range from 20,000, 50,000, etc. The higher this number gets, I would challenge the assumptions around, is this all really non-business related? I would request a GL detail and look through these business expenses, or no, look through these items labeled under officer benefits. If you see things like conference expenses or travel to conferences, those are all business costs and they need to be removed from this adjustment. That's things I see in practice. So what is the impact of this analysis? So, let's look at the adjusted EBITDA. So the adjusted EBITDA is 988,000. Let's say for all intents and purposes, you are going to be paying a 3.5 times valuation on just 2025. 988,664. So hypothetically, you would be paying $3.46 million for this business. It's very possible, this seems like a fair valuation in the space. Again, going into certain elements like, should you really be paying for the best performance of the company? If we take a look back, this company's adjusted earnings nearly doubled over the course of 12 months. I would make the case you probably want to pay a blended average of the last 3 years. Again, valuation and things like that are not applicable for the Addback analysis, so just staying on topic. If, for example, the total adjustments are $257,000, so we already identified one where I would be adding an offset. So this owner's salary, it's very reasonable to benchmark $150,000 as your salary, which you will take under the business going forward. So this Addback is now offset by $150,000. So let's show the impact of the purchase price. So we're going to take the $150,000. That's going to be a reduction of the adjusted EBITDA. If you're still with me, throw a chat, in the comments. Happy to pause and answer questions if you have any, but I'm going to keep it moving. Let's say, for example, this donations of the $5,000, $2,500 actually was business related. So we're going to pull out $2,500. And then keeping it simple, let's say this officer benefit, the full amount was actually related to travel for a conference the owner goes to each year. So let's see the impact of the purchase price. So again, $3.4 million was your offer in the LOI, or hypothetically, let's say the listed price. It's based on a 3.5 multiple at the adjusted EBITDA they showed of 988. Of this 988, it turns out that the adjusted EBITDA should be closer to $833,000. So how does that impact what the adjusted purchase price should be? $2.916 million. So by not conducting this analysis or not pushing back, it's possible you overpay for this business by $543,000. So this is why this Addback analysis is absolutely mission critical in small business acquisitions. $543,000 is effectively over almost 20% of the total purchase price. It's like buying a house 20% over market rate or a fair value rate. No one would ever do that. In small business acquisitions, things like this happen all the time because prospective business buyers are not conducting this analysis the right way, and they're not showing the impact of this analysis to sellers. So by doing this analysis, you can better 15%. You can better articulate, here is what you've presented, here are some of the challenges of the Addbacks. Here is what I think a fair purchase price is using the same multiple, 3.5 times. The only things that have changed are a discussion of, is this really business expenses? Are these expenses the business is going to pay for going forward? And this is the impact of whether or not you conduct this analysis. If you're buying this business with an SBA 7A loan, overpaying nearly over $500,000 for a business is the difference between making those debt payments and defaulting on your loan. So I walked through this example as a cautionary tale, but more importantly, I hope this gave you value on how to conduct this analysis, setting the framework for it, and then more importantly, opening up a sheet in Excel and walking through this analysis from start to finish. Once you have this, result of, hey, here's what I think the valuation should be. Now the challenge is you have to have a conversation with the seller and walk them through this process. Just because you've done this analysis does not mean they're going to accept it. It doesn't mean you're going to get what you want, but it at least gives you comfort in knowing what are the true business earnings of the company I'm trying to buy. Because once you understand what this number is, the adjusted EBITDA, this is the number the business can generate on a cash flow basis to pay off this debt, to pay off those monthly SBA payments. It's a very important number you need to know because you're still trying to understand, can this business support the SBA loan? So that's just an example. I hope you found some value in it.